Wealth can be measured in many ways. As it grows, life can quickly become complex, creating the need for more focused planning. Welcome to We're Talking Money with OmniStar Financial Group. OmniStar has been helping clients achieve financial success for more than 20 years in a client-centric and stress-free environment. With a reputation built on a long track record of working with people who want to grow and protect their assets, OmniStar illuminates the blind spots and provides actionable strategies to help you achieve what's most important. This is where you can count on straightforward and unbiased advice from a team of professionals that are passionate about your success.
All right, welcome to We're Talking Money Live, the show dedicated to illuminating the blind spots in wealth management and financial planning. I'm Sarah. This is our co-host today, Phil. Last time he was co-host, he was at home sick, I believe.
It's probably true.
Broadcasting from his office. So you got to see a different world behind Phil last time.
I didn't really like that, by the way. When I saw when I saw the video of that one, I looked sick. And I guess
you were sick.
I suppose. Okay, well, that's right. I was at home sick, but man, I really looked sick. Somebody should have said, we don't really want him to broadcast today. I didn't realize how pale I looked, but I was under the weather. Fortunately, it wasn't COVID, but I don't want to broadcast that way anymore, I don't think. So, but yes, thanks for reminding me of that. That's all good. But yeah, I'm looking forward to another show, and Sarah's in the driver's seat today. So she's our host, and she's going to take us through a theme that I'm not really sure that people are aware of as much as they should be.
Absolutely. So obviously we're on our new broadcast. You can check us out on YouTube Premiere. Most likely it's going to be at the same time. If we need to switch it up, if something's going on, there's a big event, we'll switch it up and broadcast from a different time so everyone can join us. I know most people are back at work. Makes it a little more difficult to hit that 12 o'clock show. I know I had a client reach out to me last week and he caught the first part, but he had to run around. He was a dentist, so he had a patient come in. He had a lot of things to do. So we're trying to make it a little easier to broadcast and for everyone to watch us. But yes, we are talking about something today, as Phil said, that everyone should know about, but I don't know if the awareness is out there. And it's going to be the SEC. And
we're going to talk football.
No, we're not. I would love to talk football.
You said the SEC, right?
Yeah. Everyone in this office is actually not so many people are college football fans, but they are more NFL. However,
Yep.
The SEC is dominant in the South. So, and we are in the South. So when we have clients, anytime the SEC gets brought up, they don't immediately think the Securities and Exchange Commission.
No, they're thinking about some kind of Southern conference.
Yes.
They're not thinking of the Securities and Exchange Commission. And in our world, where we run a lot of plays around here, but our plays are all about winning for our client. And the SEC makes sure that the plays that we're running are not outside of the scope of what we should be doing to preserve the confidence that a client has in a firm like ours or any other financial institution. The SEC is really there to help preserve that. Without them, I think if we go way back to the beginning of some of the major sort of undoings in the market, which led to the SEC. If you go back and look through history, you can see where investors, they really, advantage was taken, and it led to what we see today as the SEC. And so many of us in our industry, we hate having to deal with all of this stuff. We call it compliance. We never like that. But we also know that without it, I think that our profession certainly would not be what it is today. And I don't think that we could develop trusted relationships with our clients without that level of compliance. And so while it's tedious and it involves a lot of extra effort, boy, I'm glad that we have it, not only to protect our clients, but it also protects us.
Oh, absolutely. And I call it the acronym with the power because they control us, right? You know, I can't imagine a world where you work in finance and the SEC isn't, you know, the end all.
They're present. They're sort of omnipresent, if you will, and they're always looking. Now, do they always get it right? No, it's a big organization. There's a lot of moving parts, and in our profession, there's a lot of moving parts.
Mm-hmm.
And I think one of the, this could lead to additional shows, but we're not just a profession of registered investment advisory firms, which is what we are. There's also brokers, and there's dealers, and there's brokers and dealers working under one model or one roof. So there's a number of professions within the profession, and the way that it's done, I should say, and some are better than others from our perspective. But really, it might not necessarily be that they're better than others as much as it is, I think there's a time and a place for each. And as long as there's proper disclosure, then they all serve a purpose.
Mm-hmm.
And for our clientele, the brokers and the dealers, which are the market makers, if you will, that's really not what our clients are looking for. Our clients are looking for peace of mind. They're looking for simplicity of a very complicated set of circumstances or set of things that work towards them having a comfortable financial life, if you will, or a successful life. So our clientele is much different than the person who is day trading and trying to ride a stock up or sell it short and write it down. That's more the broker dealer side.
Mm-hmm.
And a much different set of rules apply to that part of our profession versus the RIA. So the SEC regulates all of that. So they have a pretty darn big order, or tall order, I should say. They have a lot of people to oversee. There's a lot of us out there.
Oh my gosh, they're very broad, very far-reaching. Today we're going to focus on the SEC, but more so the history. Why is there an SEC? What brought it about? We get a lot of questions from clients that have, if they've never worked, I guess, with a financial advisor. Most of the time we get the question, well, who's stopping you from, making bad advice or running away with my money? And it's a legitimate fear if you aren't aware of the regulations that we are, bound by.
It's a legitimate fear. And look, there's been plenty of schemes around the world, and right here in the United States, there's been plenty of Ponzi schemes, and probably the one that everybody remembers. It seems like yesterday to us, because it was such a big deal, and you learned so much from it. But the Bernie Madoff scandal was one of the most notorious traders, broker dealers, and Ponzi scheme operators of our time. Billions, 50-some billion dollars, I believe. And so this guy ruined a lot of lives. And so I think that was one of those times when the SEC failed. They could have spotted a lot of these things. In fact, there were whistleblowers, if you will, and the SEC ignored them. Bernie Madoff served on one of the boards, I believe, of the SEC, and he was just under the radar for the longest time as he was taking billions and billions of dollars from these investors. And so, to Sarah's point, absolutely, it's legitimate for these kinds of fears to be inside of an investor's mind or inside of a person's mind that might be hiring a wealth management firm or a financial advisor. So I think the SEC plays a huge role, a very important role. And the SEC, since Bernie Madoff, has really tightened the screws to the extent that we often hear the pendulum swings too far in either direction. I think in some ways the SEC had to go back and rethink some things because the pendulum was moving too far too fast. But overall, I think the balance is getting better and better. And the SEC is there for a reason. They have to protect the public, because people like Bernie Madoff can make us all look bad. No matter how good we try to do it,
Yeah.
You got the Bernie Madoffs out there that will somehow, they just show up every now and again, and it makes us all look bad.
He would most certainly be labeled a bad apple.
That guy had, I'll never forget, Sarah, when that occurred, it was a real turning point for me in terms of the way I looked at the SEC, because I never really thought a lot about the SEC. I just felt like, well, they're the governing body, and let's pay attention to what they tell us, and let's make sure we play by the rules. But when I saw what happened with Bernie Madoff, it made me realize just how vulnerable something as big and well built as the SEC can be. And so they've had to get better. You know, I think every business, every institution can always get better, and the SEC learned that as well. And I just hate that it cost investors billions and billions of dollars, money that would never be returned to them. But this guy lived such a lavish lifestyle. And Sarah, you've been in the business long enough to know that there are some firms out there, some people on Wall Street that make big, big bucks. But the kind of bucks that Bernie Madoff was spending is just not normal. It's just not
outside
normal.
of even that realm. Which
It's
is
just
crazy.
way out. I mean, he spent like a mad billionaire who had no real thought about what was, good decisions about his money. He spent money like it was literally coming out of a water faucet. So I think just that should have been a sign. But everybody seemed to ignore the fact that this guy had $20 million penthouses and multiple homes and jets and
living the good life.
Oh my goodness. Yeah. I've always thought that women had lots of shoes, but they showed his closet in one of his mansions. I'll never forget this on one of the news shows. And this guy had more pairs of Gucci's, I think, than the Gucci factory. So unbelievable.
So no wonder people don't trust our industry. That's a common theme. And when we try to educate clients, one of the things that we do talk about is the SEC, and that we are regulated. And one of the things we don't talk about is what created the SEC. So why are they around? Obviously for purposes, as Phil was just talking, but way, way back in the 1930s, President FDR decided to sign the Securities Exchange Act in 1934. And if you know anything about history, 1934 might stand out because it is immediately following the Great Depression and the stock market crash.
Yeah, one of the, obviously it is the all-time, it's sort of the all-time, if you will, go-to for lessons to be learned even today.
Yep.
It's the worst calamity that the stock market ever experienced. And so our economy was literally, as colloquialisms would have it, in the toilet. And so as a result of that, there was a lot of advantage being taken of people, hence the Securities and Exchange Commission and all of these acts that were put into place. And so we're going to talk about those, right?
Absolutely. Yep. And it's interesting to note that prior to all of this, prior to Black Tuesday, which we'll touch on, the stock market was in the
Black
longest.
Tuesday or Black Friday? Oh, I'm getting that mixed up with Christmas.
You're just trying to go shopping. You just said,
sorry.
You're talking about Gucci shoes. Now you're really thrown off.
Now I'm trying to go shop a little bit here on a Black Friday. Okay, sorry.
But no, so prior to all of this, the stock market was on the longest bull run ever for that time, between 1924 and 1929. It rose from, and these numbers are laughable today, rose from 78, the Dow did, to 380. So everything was booming. Life was great. People were making tons of money. Everyone wanted to be in the stock market. Everyone was trusting of their advisors, so to speak, back then. And it really got them into quite the pickle.
78 to 380. If you put that in context, today the market trades at 30,000 on the Dow. So, man, it's come a long way. And we're sort of toying today with this idea that it goes to 36,000 next. And there's a great book out there that was written a number of years ago. So it was prematurely written. Everyone expected it to get there long before now. But so we're heading in that direction. But gosh, just to try to compare the two, when you juxtapose 78 and 380 versus today, we're talking 30,000, and now we think about 36,000 as a realistic target. Times have changed, but back then, when you look at that number from roughly 80 points up to almost 400, you're talking about multiple multiple doublings, if you will. So what is that? 300%, almost 400% increase.
Oh, yeah,
Crazy.
absolutely. People were, like I said, living the good life. They were spending money, very extended, trusting people who were scamming them.
Yeah.
Hence the SEC, the creation of SEC. But you have to think about that time, Black Tuesday hit and everything came crashing down. Unemployment hit 25%. There were some parts when I was looking at the history of all of this, unemployment in certain parts of the US was 80 to 90%. So there were certain towns in the Midwest that were just ruined, all following Black Tuesday.
What a pivotal time. And it really changed everything in a lot of ways. We were going through a number of what seemed to be euphoric times. So, right. So we had everything was going well. We were growing. The country was just, everything seemed to be working towards nothing but the good life.
Yep.
And then all of a sudden, literally overnight, it began to change. And boy, when it changed, it was a precipitous dive and everything came apart.
Everything definitely came apart. So FDR stepped in, pulled some chairmans together. The first chairman of the SEC was actually Joseph Kennedy, which, if you know who that is, it is Mr. JFK's father. So he was the original chairman of the SEC. And their whole purpose was to dig deep and find what caused the crash and how to prevent it moving forward, which most likely was not a very easy task. This is uncharted territory. They never faced a crash like that. As Phil just said, everything had been booming prior. And, here comes the Great Depression knocking on the door.
Yeah, no one understood why. And really, no one understood how to fix it. So
No.
not only did we get the SEC at that time, we got something else way back then that's somewhat analogous to what we're seeing and feeling today and what we saw and felt in 2008 and 9 when we went through what's now somewhat cliche, but the Great Recession. So almost a depression, and many people felt like it might have been a depression, but a Great Recession. And so all of a sudden, these monetary movements, if you will, so these government interventions began to occur. And that was not the first time. So back in 2008, when Ben Bernanke was the chairman of our Federal Reserve, he was doing things like quantitative easing and printing money and buying assets. All of those things were occurring. And you heard a lot of people, particularly newscasters, they would say, these are uncharted territories, but not really.
No.
We did some of that very thing back in the Great Depression. So printing money, we decoupled from gold back then. A lot of things happened that are very similar. So when people say that history repeats itself, it may not be precisely the way history happened, but you can see lots of similarities. And I think if we don't learn from that, we're probably missing great opportunities to get better. But those very things happened back then. So it wasn't just a crash. We then had to get the economy turning its wheels again. And that came by way of a lot of printing. So we saw a lot of that back then, and we're seeing a lot of that today. So maybe we need to rebuild the SEC.
Maybe we do. Right now, the president appoints 5 bipartisan committee, and they're split.
Do we have bipartisan people anymore?
Well, you know what I mean.
Oh, okay. All right. I was just curious. I don't want to go politics on you, but I'm not really sure anybody's bipartisan anymore. It seems to me like there's 2 factions and that's it. So I digress.
Everything has gone a bit haywire. That's okay. So Division 1, Division of Corporation Finance, is going to oversee publicly traded corporations. So it's split into 5. I think I just said that. So everyone's not, responsible for each thing. And they serve terms that are staggered. So you're not going to have the same people in these 5 divisions for 10 years. So you see some changeover in that. The other division is going to be the Division of Trading and Markets. Obviously, their job is to safeguard fair and efficient trading of the markets.
Yeah, it's an interesting point because just yesterday we saw a stock by the name of GameStop, symbol GME, and they had a trading halt.
Yep.
during the intraday, and so normal hours they had to halt the trade. That's the very thing that the Division of Trading and Markets takes care of, and they're doing that to be sure that we have safe, fair, efficient markets at all times. And so when something goes haywire, we have, years ago it was all manual, and when I got in this profession almost 30 years ago, even then, when we were buying or selling securities, Sarah, way too long ago for you to remember, but we had to write trade tickets. So we literally hand wrote what we wanted to do, and that was then faxed to the trade desk.
Yeah, that's crazy. That's to me, I
Yep.
was trading today, clicking buttons, click, 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 and the trades are done.
Yep. So
Instantaneously.
we had forms, and it even seemed archaic to me.
Yeah.
But I thought, man, there's got to be a better way. And it wasn't long after that that we started getting electronic trading. They had it on the floor to some extent, but literally we wrote tickets for every trade. And if this was a real problem, because if you wrote the wrong amount, just like today, we call it fat fingering a trade. That's not to be offensive towards anybody with thick fingers, but if you fat finger a trade, boy, it can cost a firm a lot of money. But same way back then, if you had a typo on that trade ticket, that was on you. And when it got up there, nobody was calling you to confirm, and you didn't have "Are you sure you want to trade?" Press OK.
Verify.
Right.
Verify.
Exactly.
Verify.
And so today we have multiple verification methods built into our softwares, and thank goodness for that technology, because I got to tell you, I can remember how archaic those things were just 20, 30 years ago. So much different world today, but can you imagine what it was like in 34?
No, not at all. I mean, like I said, I can't imagine pre-SEC. I can't imagine trading paper. Yeah, the world has changed so drastically.
The most interesting part to me is when you go even before that and you start looking at what our stock markets were originally, and it wasn't money being traded, it was spices and grains, and those were the kind of things that had real value because there was no currencies. We're talking 500 years ago, but
pre-US.
Yeah, but those are the ways that it was those things that drove us. So this thing's been evolving for a long time.
Absolutely.
To say that we didn't need an SEC before 34 would probably be a misstatement, but it took someone like FDR to finally say, okay, wait a minute, we got to get some balance in here. And then all of a sudden here comes, but first it was the Act of 33, though, right?
Right, the Securities Act of 1933.
And that was more of a state-driven thing.
You'll hear it called the Blue Sky Laws, and it was the states were responsible for that regulation. Obviously, that didn't work out quite so well. So
they didn't police it quite the same way that the federal government envisioned, but really they were two different things, right? The 33 was all about the laws and what we call the blue sky laws. And it was really more of that, not the procedural things. It wasn't all of the things about the trades. It was here's a set of laws that each state must implement and oversee. And so it's still there. The blue skies are still there. They're still part of all the exams that we're required to take and CE that we're required to acquire every year. They're still part of that. But it did not turn out initially. It wasn't quite the result that they were hoping for. And so then FDR put his hand back into it and said, okay, let's make this a little more rigid and be sure that we get good oversight across the board.
Oh, yeah. And they've just been growing in strength ever since.
Wonder how many employees the SEC has. I don't know.
I don't know. Google it and check it out.
I think I will.
Google on the fly. Yeah, I'm sure.
I'm going to do that.
I bet they employ a ton. The next
might scare us how many.
It really might. The next division is the one that scares us, is the Division of Investment Management. So they oversee people like us, which that job in itself, when they come in and do an audit, that takes so much time and effort. I'm excited to hear this, actually. How many people?
4,200 people make up the Securities and Exchange Commission. That was just about the beginning of 2019.
Okay.
That's a pretty current number.
Oh, absolutely. And
A lot of people.
I'm sure they've hired more because they are just constantly trying their best to, but as you said, the pendulum has swung in the opposite direction and their oversight is just overwhelming almost.
Yeah, and they're always trying to evolve. So they want to give us flexibility. They want to give us that they're really not the enemy.
No.
A lot of people in our industry, in our profession, think they are, but they're really not the enemy. What they're trying to do is balance what we do and how we deliver it to the client.
Right.
And if we do that well, then all things are good. But the SEC's, their number one job is protecting the consumer. And for so many years, I think as good as the SEC was, Sarah, the SEC, they had good rules in place. But early in my career, I always felt like it was buyer beware.
Mhm.
I really felt like that the onus of responsibility was on it was on the consumer. It wasn't on the advisors. The advisors just had to follow something called suitability rules. They didn't have to disclose so many of the things that we have to disclose today. And I just think that was probably poor. It certainly was not prudent management, whether it was at the SEC level or any other institution that was in between that and an advisor, or all the way down to the advisors or the broker dealers. I think that we probably missed that for a lot of years. And today the SEC is catching up on a lot of that. I think they're trying to make up for a lost time if that's possible. But the fact of the matter is, they are there to protect the consumer, and it shouldn't be buyer beware. There should be things put in place that allows a consumer to feel confident,
Mhm.
and to know that what they're getting is exactly what the advisor or the firm that they're choosing to work with. It's what they're offering, what they're saying they're going to provide to them is exactly what they're going to get. And I don't think it was always so cut and dried.
Oh, I believe that. I believe that entirely. And one of the things too for clients to know is there's the division of enforcement. So they do enforce their laws. They do come in, they will shut you down immediately if need be.
Yeah,
So that
true.
division is very, very critical to the SEC. And then the last one is just the division of economic and risk analysis. So it's going to monitor changes in the economy. They are the ones sitting there watching all the charts, making sure everything is not, well, as you just said, uncharted territory. They're the ones monitoring those types of things.
Yeah, they want to make sure that we don't have a state of chaos and it
Yep.
go unknown, because if it does, I think that as the economy changes, markets are generally ahead of that. Markets tend to bet on what's going to happen. And if the SEC is not looking at that very closely, markets can get they can get a little wobbly, a
They
little
can get out of
crazy.
hand.
Yeah, they can get a little unstable. So the economic component in risk analysis, it's very, very important. And I think they do a reasonably good job with that. But as you said, they're always evolving, and I think the SEC is here to stay. They're not going anywhere. I believe they're going to get better and better and more effective with the way they manage us, or at least the way they hand down the responsibilities that
Mhm.
we all agree to when we come into this profession. And as difficult as it is sometimes, and as much extra work as it puts on a firm to follow all these things and monitor all these moving parts, I got to tell you, it would be a risky profession, and riskier still for the consumer if we didn't have some of this regulation. So, can't say that I love it all the time, but I'm also not a hater because I know it's there for good reason. So, yeah,
Absolutely. And Phil says he can't love it all the time because he is our chief compliance officer. So it falls to him much of the work. Just like next week, we're going to be talking about Form CRS. We're saying SEC continues to evolve. They are pushing new things out. Mid-year last year, I believe it was June 30th of 2020, they push out the CRS, which is the client relationship summary. That is for the end consumer, so your client. And it gives you very detailed, plain language, questions to ask, but we'll cover that next week. And if you're a client of ours, always, always, always make sure that you're asking us those questions that we go over next week. Or if you're with another firm and you haven't seen the Form CRS, you should probably check it out and make sure that all of the questions on there you have answers to.
Yeah, I'm pretty excited to talk about that form. It is new. It came into existence last year. It's been in existence for a while, but it became mandatory last, I believe, June. And it took quite a bit of work to put ours together. And along with some of our compliance folks that we work with, it was a pretty lofty thing to build and build it the right way. But it's truly, it was always about a conversation starter, because a lot of times a consumer doesn't know what to ask. And so this form CRS, it's not a form, it's almost like a white paper, but it has specific questions, and it really helps start a conversation so that you can better understand what you're getting into as you hire an advisory firm. So we'll dig into that actually I think we'll go pretty deep in that next week. It's going to be a fun thing to talk about, and I'm excited to share a lot of the answers that are on our CRS.
Oh, yeah.
I think it'll be an interesting conversation, and it'll also set the tone a little bit, and sort of what you should be looking for. It'll set all of that into a very understandable context, so that if you don't work with us, you at least begin to understand that this is a requirement. You shouldn't have to ask for this. It should be given to you. And if it's not, that's a red flag in itself. But yeah, it's going to be exciting to talk about that next week.
Absolutely. As we close out, don't forget, we are on Instagram, we're on Facebook, we are now on YouTube. We've been on YouTube, but now we are broadcasting our live show via that route. So no more Zoom link. You don't have to constantly log in and join our webinar. You can always go to YouTube, see our previous shows, but also when you're there, make sure that you hit subscribe, right? You have to subscribe to know what's going on.
That's right. We need you to subscribe, and that tells us that you're watching, and it lets you know that you're not going to miss an episode. Once you subscribe, you're always going to know when they're coming. You can get prepared to enjoy more educational formats that we're working hard to put together for you.
Yeah. Well, everyone, have a great week. We will see you next Wednesday.
Thanks for joining us on We're Talking Money. Be sure to visit our website, www.omnistarfinancial.com, where you can learn more about how we provide value to our clients. Subscribe to the show and our newsletters, and drop us a line with suggestions for upcoming shows. If you enjoyed today's episode, we'd appreciate a rating on iTunes, or simply tell a friend about the show. This podcast is a publication of OmniStar Financial Group. Any information provided has been prepared from sources believed to be reliable, but its accuracy is not guaranteed, does not represent all available data necessary for making business or investment decisions, and is for informational purposes only, and does not represent or constitute any recommendations. All expressions of opinion reflect that of the authors and are subject to change. If this podcast contains any projections, forecasts, guarantees, and/or predictions of any kind, you're required to ignore the same. OmniStar is not engaged in the practice of law or accounting, and any information in this podcast should not be construed legal or tax advice. Any distributions, use, or copying of this podcast, other than the intended recipients, is unauthorized.